Yesterday, oil prices declined, and today our focus shifts to the U.S. elections, the impact of Hurricane Rafael, and the potential for reduced oil demand from China. We will be concluding this report with a technical analysis of WTI's daily chart. The U.S. presidential elections have now concluded, with a clear victor having emerged on Wednesday. Specifically, Donald J. Trump is now president-elect, with his inauguration set to occur on the 20th of January 2025. Nonetheless, we now look towards Trump's policies, and in particular the comments made in regards to bringing energy prices down, as the incoming administration's policy may impact oil prices. In particular, the president-elect has vowed to unleash the U.S.'s energy dominance by streamlining permits and ending restrictions on oil, natural gas, and coal, which in turn could allow energy firms in the U.S. to vastly increase oil production levels, and thus by increasing the supply of the liquid gold, oil prices may decrease. Moreover, with the Republicans set to control the Senate and potentially the House of Representatives, any legislation in favor of increasing oil production levels and permits brought forth by the incoming administration may meet little to no resistance before being signed into law. In turn, this may aggravate the bearish effect on oil prices should the Republicans manage to secure the trifecta. On the flip side, should the Democrats manage to take over the House, it may have the opposite effect and could instead aid on oil prices in the short term. Hurricane Rafael at the time of this report is a Category 2 hurricane and has entered the Gulf of Mexico after passing over Cuba. The hurricane could potentially disrupt oil production in the Gulf of Mexico up until next Tuesday. In turn, market worries about a possible disruption of oil production in the region may have mitigated some of the downward pressures exerted on oil price since the U.S. election. Furthermore, some storm tracking websites have identified another potential disturbance in the area, with Zoom Earth claiming 20% probability of the disturbance developing into a tropical depression or tropical storm in the next 2 days. Nonetheless, should further hurricanes form in the region, which may threaten the oil production, we may see supply chain concerns translating into support for oil prices. According to a recent report by Bloomberg, oil imports in China have decreased once again during the month of October. In particular, imports contracted to 44.7 million tons in October, which would be 2% lower than the figure in September, and when compared to last year's data for the same month, it would be 9% lower. Overall, it appears that the slack in demand from the world's largest oil consumer may be worrying for the longer-term demand for oil. Thus, should concerns about oil consumption from China further intensify, we may see downward pressures being exerted on oil prices. WTI's price action edged lower after failing to clearly break above our 71.50 resistance level. We opt for a sideways bias for the commodity, and supporting our case is the RSI indicator below our chart, which currently registers a figure of 50, implying a neutral market sentiment. For our sideways bias to continue, we would require the commodities price to remain confined between the 64.75 support level and the 71.50 resistance line. On the flip side, for a bearish outlook, we would require a clear break below the 64.75 support level, with the next possible target for the bears being the 57.30 support line. Lastly, for a bullish outlook, we would require a clear break above the 71.50 resistance line, with the next possible target for the bulls being the 78.0 resistance level. Thank you for tuning in to our financial news. From all of us here at IronFX, we wish you solid trading.